So in previous class, what we were discussing? Banking, okay. Banking what? So what you have discussed in banking chapter? What we have discussed in banking chapter? What is bank? Please give me a minute. What is bank? Okay. Example for the bank? Which are the examples for the bank? Just tell me the random banks names. SBI. Then Asha, where you are having the account? In which bank? Indian Bank. Then yeah. Okay. Then okay. And what are the different types of accounts that we will see in the banks? Yeah. One is demand deposit, one is time deposit. In that you will be seeing the saving account and current account. And the next one is fixed account or term account. Okay, term deposit. Next, what is NBFC? NBFC is okay. It will not. What it will do? Provides loans and finance like a bank, but does not have a full banking license. It offers demand deposits. Demand deposit means it cannot offer demand deposit. Which are the demand deposits we are having? Saving account and current account. That is not there in the NBFC. That kind of facility is not provided in NBFC bank. Okay, this is one of the differentiation between banks and NBFC. Next one is it is regulated by RBI also. All the banks and NBFC is under the RBI, but this is not a full-fledged banks and it is not having full-fledged license. Okay, these are unregulated banks. Okay, NBFCs, it is not having the full banking licenses. Okay. Just today I will send you the PDFs, okay, in the group, WhatsApp group. Just you can write in a keywords format, just in a keywords format. Then next, we have already studied this one. Okay, venture capital funds, merchant banks, and stock broking. That is security market. Totally under the comes under which one? SEBI. Okay, all your stock market that is controlled by the SEBI itself. It will regulate all this security market. That is stock market. Okay, if you wanted to purchase the share or if you wanted to sell share, and also whatever the third party apps you are seeing regarding the stock market, that is Grow and Angel One. Have you seen that Grow and Angel One, that kind of third party apps, whichever you are using, that all is regulated by the SEBI itself. Okay. Next is insurance. Insurance is regulated by the IRDA, that is Insurance Regulatory Development Authority. Insurance Regulatory Development Authority. That will make the laws, that will create the laws, and also that will give the guidelines and also rules and regulations for insurance companies like LIC, GIC. Okay, and there are different kinds of insurance companies, foreign insurance companies that are working in India as well. Okay. Next is housing finance companies. that is regulated by the NHP. Next, Nidhi Company, that is regulated by the Companies Act 1956. Okay. Chit Fund is regulated by the Chit Fund Act 1982. Next, all these are the NBFC banks, your Bajaj Finance Company and also Muthoot Finance, HDB Financial Services, Tata Capital Financial Services. These are all the NHP. Okay, sorry, NBFC. Next, RBI role and functions. Okay. We have studied all this. Okay. Who will just regulate the monetary policy? RBI will regulate the monetary policy. Like all this Repo, SDF, MSF, LAF corridor, that all I will just define that. Explain also. And currency is issued by whom? RBI itself. Okay. Apart from 1 rupee, all the currency will be issued by the RBI itself. Okay. Regulation and supervision of banks and NBFC. All the banks and NBFC will be regulated by the RBI itself, and it is the banker to the government and also banker to the banks as well. Bankers Bank. RBI is also called as Bankers Bank. Next is debt management. G security auction. See, if there is any kind of a loan wanted for the government, then this is the one who will purchase the G security. This is the RBI that will purchase and sell the G securities on behalf of government. Whenever the government wants a loan, huge lump sum of loan in thousands of crores, RBI is the one who will provide money by taking the G security. G security means government securities in the form of loan, in the form of bonds. Okay, have you seen the bonds? At least have you seen the government bonds? Have you seen? Okay, this property bonds or whichever the finance bonds that you are having, the same way there will be government bonds that will be issued under the name of Government of India itself or Government of State. Payment system overnight, that all NEFT, RTGS, UPI will be coming under the RBI itself. Okay. Next is NDTL, very important. Okay. NDTL, okay. Net demand and time liabilities. Demand plus time liability of a bank, okay, that is certain items like balances with other banks and refinances based on CRR, SLR calculation. Okay. See, let me explain you in detail. If a bank has been established in the year 2025, okay, any of the person establishes a bank, okay, and think that if he is having 2 crore rupees as a fund, okay, he again wanted, okay, what is the function of bank? What it will do? Function of bank is accepting the deposit and lending the loans for the other customers. Now, whatever the deposit amount, think if any of the person deposits 100 rupees, if any of the person deposits 100 rupees, out of 100 rupees, this bank can't issue the total 100 rupees as a loan for another customer. Okay, think that I have deposited 100 rupees in one of the bank. That bank cannot give total 100 rupees for another customer as a loan. Okay, here the bank should give the loan based on NDTL, based on CRR, SLR. Understood? It might be around about 70 rupees only. 70 to 75 rupees can be issued as a loan. Rest of the amount, whatever the 30 rupees, that should be deposited in the form of CRR, SLR under itself, under the bank itself. Understood? What I am telling is, if I have just deposited 100 rupees as a 100 rupees one of the bank, it can't provide the total amount as a loan for the other people. It should have some reserves, certain reserves. It is called as emergency reserves. Okay, that is called CRR, SLR. Cash reserve ratio, statutory liquidity ratio. Okay, that should be that is a kind of a emergency reserves. Okay, this both are dependent on NDTL, that is net demand and time liability. Demand means, what is the demand? Demand account. Demand account. Which are the two types? Savings and current. What is savings? Savings means you will be getting the interest for that. You will be getting the interest rate for that, for your money, whichever you have deposited. For current, you will be not getting any kind of interest loan. These kinds of loans, these kinds of accounts along with time liability means the term deposit or fixed deposit, whatever you had, based on that, it is calculated as NDTL. And also along with that, whatever the loans this banks have been taken from another banks, either it might be RBI or else from another bank. See, some of the banks will be having the treasure in the form of deposit. Deposit will be in the form of either saving account, current account, whatever the customers they have kept, and also the time, the term or else fixed accounts. Do you know FD, fixed deposit, means for 6 years it will be double in. That is kind of fixed accounts. That kind of customers, all that money will be summed. Then they will also calculate whatever the loans they have taken from other banks also. Okay, that all is calculated, then it is called as NDTL. Time liability means after maturity period, the banks should again repay that for the customers or not. After 5 years or 6 years, again they should repay along with the interest rate for the depositors. That is called as NDTL, net demand time liability. Net demand means total this one. Time liability means whatever the term deposit they have done, that all along with that the loans, whichever if the SBI has taken the loan from some other banks, it should pay back after certain days or after certain months along with the interest rate. That all will be calculated and it is called as NDTL. Is there any doubt here? No doubt. Okay. See here, if demand is 10 crore rupees, time is 20,000 crore. Time means here term deposit. Okay. And adjusted exemption and adjusted exemption total all, they will just increase that. Okay. Plus or minus. And totally they will calculate and it is around about 28,000 crore rupees. That is the turnover. That is the money the one of the bank will be having. Understood? Demand means saving account plus, there I have written saving account plus current account. The total money, if one of the banks think this is the SBI, if the demand account, that is saving account and the saving account and current account customers, total deposit is 10,000 crore rupees plus fixed account whatever the term deposit or fixed account they are having, fixed deposit, that money, adjusted exemption plus or minus along with the loans also, totally it is 28,000 crore. That is the net demand time liabilities, summing of all those. That is the total turnover, or the bank will be having that much of money. That is not totally the bank's money, that is the customer's money. Understood? This all is a customer's money. Based on that only these banks can issue the loans. Understood? Based on the NDTL, the bank can issue the loans. As I told you, the deposit amount of 100 rupees will not be issued as a total 100 rupees as a loans for other customer. Okay? It should keep the reserve based on NDTL. See, net demand time liability means here what happens is net means total. Demand means saving account and current account plus time liability. Has this saving account plus current account plus term deposit, fixed account. After maturity period, again it should pay for again back to the customers. We don't know at what time the customer might come and take their money back. Even though the maturity period is for 5 years, sometimes the customers will tell that in emergency, okay, there is an accident has happened for my parents or something, I wanted my money back, okay, before maturity period that overs. What they will do, the bank will deduct the interest rate in that principal amount and they will issue that principal amount. Understood? Think that if the maturity period, if doubling of the money is for 6 years, think it is 10 lakh. I have kept 10 lakh as a fixed deposit, term deposit in one of the bank. It is for 6 years. Then at 4 years, after 4 years, I may go for the bank. See, after 6 years only, I will get doubling of my income, doubling of my 10 lakh rupee. It will be how much? After 6 years, it will be 20 lakh. Term deposit means what? Fixed deposit means doubling of your deposit. That is, after 6 years only, you will get your 20 lakh back. Think that for 4 years, I have waited and in emergency case, I wanted to withdraw my money. During that time, during that time, what this bank will do? They will deduct for 20. I mean, that is what the 10 lakh or 10 lakh, if it is 20 lakh, okay, for 4 years, whatever for 4 years I have deposited, only that much. Okay, think that. Just divide this for 6 years. How much for 1 year? For 1 year, how much? 3.3 lakh. 4 5s are 20. Okay, 3.5 I think. Just divide that. No, that is not for 10 lakh. If it is for 10 lakh, see, this is the principal amount I have kept. I will get extra or not? Extra 10 lakh we are getting. See, 10 lakh it is fixed. I have kept. They should give me 10 lakh. Beyond that, this is in this amount from 10 lakh to 20 lakh, there the deduction will be happening. Understood? I have kept as a 10 lakh. They will not deduct in this principal amount. They will not give me only 6 lakh or 7 lakh. I have kept as a 10 lakh over there. They will give me my 10 lakh. But whatever from 11th lakh, 11, 12, 13, 14th lakh, from 11 to 20th lakh, there the deduction will happen. Understood? They might give me around about only 14 or 15 lakh rupees itself. Understood? Think that if it is for 12%, okay, doubling might be 12%. If you withdraw the money before maturity period, they will calculate only for 10%. Understood? That is a penalty. Understood? They were issuing the fixed deposit at 12%. Before maturity period gets over, what you are doing? You are withdrawing the money. That is why they are reducing your interest rate. It is a penalty. Understood? Is there any doubt here? No doubt? Rohan? Okay. Let me explain you once again. Think that I have deposited of 10 lakh rupee. Okay, in one of the bank. Just concentrate here. and my total money will be doubled after 6 years. That is the fixed account or term account. Fixed account or term account. Okay. If I go for the one of the bank, okay, so called X bank, I have deposited 10 lakh and the manager has told me that your money will be doubled after 6 years. Once the maturity period gets over, you can take your 20 lakh.
After 6 years?
After 6 years. Till 6 years, you will not get any kind of interest rate. This is called as fixed account, fixed term. Sorry, fixed account or term account. Understood? You will not get any monthly interest rate for this money. Why? Because you are doubling your income. Understood? There are different types of accounts. You will be getting the interest rate on monthly basis also. If you want that, you will be using savings account. In saving account, you will be getting a monthly interest rate for that. But for fixed account, you will be not getting any monthly interest rate, whatever you have deposited the amount. Okay. Only the thing is, after 6 years or after 7 years, your money will be doubled and given. But they will not issue monthly basis interest rate. Understood? Here, if you want to withdraw after 4 years itself, it is before maturity period gets over, what they will do, think that this 10 lakh is issued at 12%. This 10 lakh is issued at the rate of interest rate 12%. After 6 years, it will be double. But before maturity period gets over, you are withdrawing money after 4 years itself. Now, how much money you will be getting? Round about 14 to 15 lakh. Okay, round about 15 lakh. Think it's a 15 lakh. This 15 lakh is issued only at 10%, not 12%. Because still 2 more years is there to get matured. You are just withdrawing the money 2 years before itself. That is why you will be not getting the interest rate at 12%. They will give only at 10% of interest rate. Then if they have issued at 10% of interest rate, your money will be got deducted. It is not much amount for you then. Understood? Is there any doubt? No doubt. Okay. Let us study the definitions. First one is repo rate. These are very important for your exams perspective. Just put the heading repo rate. Just concentrate here, don't write. Don't write, concentrate here. There is RBI, there is a bank. Okay. Think that bank wanted a loan. Okay. If a bank wants a loan, okay, RBI will, what it will do? It will lend the money. Whenever the bank wants a loan, RBI will lend the money for the banks. Okay. At the current rate of 5.5% right now. Okay. This varies. Okay. Here what they have written. This is the interest rate. This is the interest rate. It is charged by the RBI. Who will charge that? RBI will charge. Why? Because it is lending a money. It is giving a money for banks as a loan. Okay. On the short-term loan. See, this repo rate is a short-term loan, and this bank should give a collateral. I mean, the property. Property should be in the form of G security. G security means government bonds, government securities. Okay. It can't issue the collateral in the form of any kind of properties like agriculture, land, or else commercial plots. No, it should only give the collateral in the form of G securities itself, government bonds. Banks should provide government bonds for the RBI. RBI will keep the government bonds for itself and it will give loans for the banks. If the bank is unable to pay that loan, what this RBI will do? It will sell the government securities. Why? Because it has kept as a collateral. Government securities having a lot of weightage in the market. It is not risky to invest some money in government bonds. Understood? The first top priority comes for government security. Then all the other kinds of properties will be coming in different kinds of slabs in a risky way. Okay, is there any doubt? If you want to invest in a government security, it is a safe zone. It is a safe that governments, see, the government is not kind of insolvency, it goes. Okay, government will be having a lot of property in its name. Okay, so it will sell and it will repay back. Understood? It is not risky to invest our money in government securities, government bonds. Is there any doubt? Here what it will do in repo rate means, what is repo rate? It is the interest rate that will charge by the RBI to the banks, and banks should give collateral. Okay, without collateral the banks don't issue the loans at repo rate. What is the repo rate? Current repo rate 5.5% of the repo rate. Is there any doubt here? This is for only short term, 14 days, 14 days, 91 days, that kind. Just highlight that, short term. Okay, you just write in the form of keywords. Okay, anyway we'll send you the PDF, don't worry about that. Just write only the kind of keywords. RBI will lend loans for the banks. Is there any doubt? Repo rate is RBI will lend a loan for the banks. Now, reverse repo rate. Reverse means banks will just lend a loan. It is not actually called as a loan here. Actually, the RBI is not under a loss. RBI is having a lot of profit. It is having surplus money. Lakhs of crores of rupees it is having. 50,000 crores of rupees, 70,000 crores of rupees. It is surplus in nature. But why these banks will lend the money for the RBI is that, just I will give you a hint. Okay. Here there will be RBI, here there is a bank. Now what the bank will do? Bank will lend the money for the RBI. Why the bank is giving for the RBI is because RBI didn't ask to give as a loan. RBI is having surplus of money. Why the bank is offering a money for the RBI is that, here think that if none of the depositors, if none of the loans, none of the customers are taking the loans. Okay, there are a lot of people are only depositing the money. If there are hundreds of people depositing only the money in banks, and the people, some of the people are taking the loans at shorter quantity. Okay. If there are hundreds of depositor, the loan takers might be only 20. What the bank will happen? There will be a lot of treasure will be deposited in the bank. Surplus of money has been deposited by whom? Depositors. The loan takers are not much in number. And when there is a huge money in a bank, what the bank will do? If the bank keeps it for itself, will it double the money? No. Okay. It is just a zero interest if it keeps for itself. What the bank will do, if none of the loan takers are there, at least it will provide it for RBI and it will get a interest rate of 3.35. At least small amount of profit will be got from the banks. Is it good or this one is good? Keeping the money for the bank itself at 0%, is it good idea or just leaving the money for RBI? At least it will get this much of interest rate.
What will RBI already it has started?
See, RBI, what it will do is, it will utilize that money, it will give that money for the government when the government wanted a loan.
Gives to government.
Yes, gives for a government. Government should give government securities, the collateral. RBI will give as a loan for the government. Understood? Is there any doubt? Bank will not be under any loss. Sorry, RBI is not under loss here. RBI is having sufficient money, surplus money. But instead of keeping itself, instead of keeping this money itself, what the banks will do? At least this is a plan B, that if none of the people are taking as a loans, see, these loans will be provided at 10%, 11%, 12%, or up to 15% for the customers as a loans. If these people are not taking this money, then it is a huge loss for the banks, because more number of depositors are there. Loan takers are less in number. That is why what it will do, the bank will keep that money under RBI, at least it will get this much of percentage as an interest rate. Is there any doubt? Just write it in your own words. Every year, RBI is giving round about it's 70% of the surplus money for the government. Why it is giving? This government can utilize that money and it can give a better, and it can develop the country. Okay, it can give best infrastructure for the people. RBI, what is the function of RBI? It is a banker to the government, banker to the banks. Okay, when it is having surplus of money, okay, it will give it as a grants itself. Okay, it will give 70% of its profit for the government every year, so that government can spend that money, utilize that money for schemes, for policy purpose, for economic growth purpose. Is there any doubt? No doubt. Next. Okay. The next is SDF, that is Standing Deposit Facility. This is the interest rate paid by the RBI on the short-term loan the banks offer to the RBI. It is same the repo rate itself, but absence of collateral. See, in repo rate, what was there? There was a collateral that the banks should just keep it as a collateral under RBI. But in SDF, there is no concept of collateral here. Here it is collateral, here there is no collateral. Understood? This is the interest rate paid by the RBI on the short-term loans banks offer to the RBI. This is the interest rate paid by the RBI. Okay, this is reverse of, sorry, this is similar to the reverse repo rate itself. Okay, this is similar to the reverse repo rate. Here there is presence of collateral, here there is no collateral. Just concentrate here, concentrate. Collateral means government security. This is not risky. This is risky without collateral. If the bank, okay, deposits a money in a RBI without collateral, it should pay the RBI should pay this much of money. Understood? Why? Because why so? That is what the RBI will pay more money here. When there was a collateral, see here, just I will write down. RBI is there, bank is there. There is a bank. What this bank will do? If there is a huge money in the bank, it will just deposit that money under RBI as a collateral and non-collateral. Collateral means if there is a collateral, it is called as reverse repo rate. What is the charge for this? 3.35%. Why? Because the collateral is in the form of G security. If there is no collateral, if the bank is not having any G security, it is not depositing, it is not giving. Okay, sorry. See you. If the RBI don't provide any collateral for the banks, then it is risky for the banks now, and it is paying a huge interest rate. See, when there is a collateral, what you will do? You will just charge lesser interest rate. If there is no collateral, you will charge double. You will charge more. Why? Because it is very riskier. RBI is telling that I will not provide you any collateral, I will not provide you any government security, but I will pay you huge interest rate. Compare here. It is 2% increased. It is increased in 2% or not? Okay. If the bank wants huge interest rate, it will tell for RBI that don't provide any collateral, I want this much of interest rate. If the bank thinks that I want a collateral from you, but I don't want huge interest rate, but I need only this much of interest rate, then RBI is ready to pay that interest rate. Is there any doubt? No doubt. Okay. Next is MSF. This is a kind of a repo rate itself. Kind of a repo rate. Okay. Here, see here. Marginal standing facility. This is the interest rate charged by the RBI on its short-term loans, overnight non-collateral based offered to the banks. If the bank wants any kind of a loans at a short term only for overnight means this is called as MSF, that is marginal standing facility. It is of 5.75%.
Same like Repo.
Same like repo itself, but no collateral. This one is introduced in 2011 and 12. This MSF will be always higher than the repo rate. Why? Because no collateral. No collateral means risky. Very much risky means it should pay huge interest rate. Just compare here. What is repo rate now? 5.50. What is MSF? 5.75. Okay, 5.75. Is there any doubt? No collateral means it should pay higher interest rate. Less collateral means it will pay less interest rate. Then bank rate. The interest rate which is charged by the RBI on its long-term loans offered to the banks. If a bank wants a long-term loan like more than 1 year, 5 years, 10 years, then it will charge 5.75% for the banks. Who will provide the loans here? RBI. Okay. Just write down. RBI. This is bank. Okay. Long-term loan. If bank wants a long-term loan from the RBI, then it is for 5.75. Is it same like a repo rate or not? Concentrate here. What is repo rate? Yeah. If the bank wanted short-term loan, then it is called as repo rate. If the bank wants long-term loan, then it is called as bank rate. See, what was the repo rate? 5.50. It is for short term, only 14 days, 91 days, 182 days, less than 1 year. Okay. It is for, 14 days, 91 days, 182 days, 364 days. Less than 1 year. 365, no, it's not a 365, it's 364. A long term means more than 1 year. This is a short term. Okay. Long term is higher interest rate, higher risky. That's why the interest rate is more. Think that if I have given 1,000 rupees as a loan for your friend, if your friend tells that within 14 days I will return your amount, then you will charge only this much. Why? Because you don't feel any risky. Within 2 weeks he will pay your amount back along with the interest rate. If he told that after 1 year I will pay you, what you will do? You will increase the rate. Why? Because you feel risky. When there is a huge risk, huge interest rate, that you will charge. Understood?
Therefore, for the long term EMI.
Yeah, long term EMI itself. Here, this is where the RBI is giving us loans for the banks. Think that if the bank becomes bankruptcy or bank insolvency, it is a loss for whom? RBI. That is why it will tell that it is risky for me to give a loan for 1 year, for more than 1 year. That is why I will charge you more. But the banks for the customers, that is different. RBI to the bank, that is different from banks to the customers. Think that for the short term, for 1 year, if it is 12%, if it's for a long term, if you have purchased the car for 5 years, you have took as a loan, okay, and after down payment, what you will do, your interest will you should just pay your interest, okay, based on monthly basis. That loan might be for 5 years, okay. If it was a short term, means it might be a 12%. For long term means it might be 11 or 10%. Why they are providing at lesser interest rate for long term? Why they are paying? More income they will get. Okay, let me tell you. Here is a bank. Okay, this is a vehicle loan. Okay, if you have taken it for 1 year, it is 12%. Think it is 10 lakh. Think that car is 10 lakh. Okay, you have took 10 lakh as a loan. It might be 13 lakh. Okay, down payment, you have made down payment of yourself or something, and the rest of the amount you have just made it as a loan. Okay, 10 lakh for 1 year, it is 12%. What is the total amount you should pay for the bank now? 1,20,000. Oh, 1,20,000 you should pay now for the bank. Sorry, 10 lakh. 10 lakh or else 12 lakh? How much? 11 lakh 20,000. Is it so? 1 year of interest rate. Yes, 11 lakh 20,000. Okay. And if you want a loan for a long term, think it is for 5 years. If it's for 10%, then calculate now. 15 lakh? 15 lakh. Which is more profitable for banks now? Which is more profitable for the bank now? This is more profitable or this one is more profitable? 15 lakh is more profitable. Why? If you have took only 10 lakh here as a loan, 1,20,000 is interest rate you have paid. Here, 15, if you minus 10, 5 lakh you have paid as a interest. That is why they will issue the loans at lesser interest rate. It is kind of attraction they are doing for the people for a long term. If you take a loan at short term, it is not much profitable for the banks. If you take a loan at longer time, long term loan, then it is profitable for them. In order to attract the customers, that is why they will make this one as a lesser. Short-term loan will be provided at 12%. Long-term loan will be provided at 10%. Obviously, you will think that 2% is lesser, but that is huge burden for the customers. Understood? Okay. In that only they will pay the salaries for the employees and infrastructure, rent and everything. Most of the banks, they are rental banks only. They should pay the rent. They should pay the electricity bill. They will just tell you, take the long-term loan.
In bank, they take collateral.
In bank, yes, they will take collateral. And since it is a long term, they will take a collateral. Okay. It's a collateral itself. Okay, next is reserve ratios. As I told you, what is the amount they will just keep it as a reserve? If it is 100 rupees, think if it's 100 rupees that is deposited from one of the customer, what the bank will do? It will give or it will provide only 70 rupees as a loan. Rest of the money should be kept as a deposit itself. Understood? Okay, let us see this one. This 30 rupees. Around about 30 rupees. It's not exactly 30 rupees. Understood? Okay. There is a reserve ratio. The bank should keep the reserve. Okay. In that deposit amount only, it should keep some amount, some portion of the amount as a deposit, as a reserve. Okay. Let us see. See, based on the NDTL, it is of two types. Okay. That reserve ratio is based on NDTL, as you have already studied the NDTL. What is that? That is one of them is the cash reserve ratio, another one is SDR, that is statutory liquidity fund. Okay. Let us study each one. Just concentrate here, don't write anything. Cash reserve ratio, it is already given in the definition letter. Reserve should be in the form of what? Cash. The CRR is a percentage of the bank's total deposit that must be held in cash with the central bank, which is central bank in India. Okay. What the banks should do? Banks should deposit the amount, certain portion of the amount under RBI. Let us see how much percentage. It is 4%. Out of 100, 4 rupees should be kept as a CRR in the form of cash only, hard cash. What is the purpose of doing this? Why they will do the reservation? Sorry, why they will reserve this cash? See, the main purpose is central bank uses CRR to control money supply. It is controlling the money. 100 rupees of a deposit is not giving as 100 rupees as a loan. What this RBI is doing? It is controlling the money. How it is controlling? Telling the banks to keep certain portion of reserves for yourself. Are you understanding? Think that if 100 rupees as a deposit amount is given totally the 100 rupees as a loan, the people will be having more money. If the people have more money, what it will lead to? Inflation. That is why in order to control inflation, CRR money is kept as reserve. Now are you understanding how they will control the inflation? They will control the inflation by various means. That is increasing more CRR. Think that. Now it is 4%. Okay. If it is 6%, more money is being controlled now. Why? Because bank should keep how much money? 6% means out of 100 rupees, 6 rupees it is keeping for itself. Understood? 100 rupees is not given as 100 rupees as a loan. Why? Because the more money is having under the hands of people, the more they will purchase, it will lead to inflation. Understood? People should not have much money. It will lead to inflation. Okay. And also that is what I have told you. It influences inflation by adjusting the amount of money available for lending. In order to control inflation, CRR can be increased. If it is 4%, if there is more inflation, they can increase it for 5 or 6 also. But minimum is 4%. Example, if a bank has 100 crores as a deposit, CRR is 4%. That is 4 crores should be kept as a cash reserve under the central bank. Is there any doubt? Very important. Central bank may not pay interest on CRR deposit. Central bank will tell for all the banks to bring 4% of your NDTL. And these banks will go and deposit the money in the RBI. But RBI will not give single penny. RBI will not give any kind of interest for the deposit as a CRR. Is there any doubt? Okay. The cash reserve ratio is 4%. Statutory liquidity ratio is 18%. Let me explain SLR also. Cash reserve ratio, the reserve will be only in the form of cash. This SLR will be in the form of cash, gold, and also government security. Just write down in your keywords, then I will explain. You want to write CRR in the keywords? Want to write? This constant rate, yeah, afterwards you can write down. Okay. Constant rate SLR. What is SLR? SLR is a percentage of the bank's total deposit that must be held in liquid asset. Liquid asset in the form of cash, gold, government security. These are called as liquid asset. What is liquid asset? Why it is called as liquid asset? Yes, you can soon convert into money. Highest liquid is cash itself. Next comes the gold. If you just sell the gold, within a few hours you will get your money. If you just sell the government security, within short period of time you will get your money back. If you sell the property, it takes lot of time to sell the property. You will not get the money within 1 day or 2 days. It is a process. Understood? Agriculture land, commercial plots, all these are not liquid assets. What is the purpose of SLR? This is very important. SLR is intended to ensure the solvency of banks. Solvency of banks means banks will go into huge loss and it will be shut down. That is called as insolvency, bankruptcy. Insolvency is also called as bankruptcy. Okay. In order to control the bankruptcy or in order to control the insolvency, SDR is kept. Okay. In order to control the bankruptcy. See, and their ability to meet deposit withdrawal demands. See, think that today I have, a few years back I have deposited 10 lakh rupee and today is the maturity period will be getting over for my 10 lakh rupee and today is the date where I will go for the bank and they should pay me the amount. If the bank is not having my amount, whatever I have deposited few years back, then it is called as bankruptcy itself. Whenever I go for the bank, it is the duty of the bank to provide my money along with the interest rate. That is why in order to meet the withdrawal demands, it should keep the reserve. Understood?
With them only.
With them itself. Okay. Actually, it is kept under RBI also. Okay, it is kept under RBI also. Both CRR, SLR. Okay, but for CRR, there is no interest charge will be given by the RBI. But for SLR, the RBI will give the interest rate. Okay, let us see how. If a bank has 100 crores in deposit, SLR is 18%. Means how much? 18 crore it should keep in a liquid asset. Liquid asset means cash, gold and government securities. That much of money. If the bank is having 100 crore rupee, in that 18%, it should keep it in the form of cash, gold and also government security. 18 plus 4. 18 plus 4, 22. 22% of the reserve should be kept under RBI. That is bank itself. Rest amount, how much? 100 minus 22. 78% should be given as loans. For vehicle loan, for agriculture loan, for personal loan, okay, etc. Banks earn interest on SLR. For the 18%, RBI will give the interest rate. Is there any doubt? Then next comes the CMM, call money market. Very important, call money market. Just don't write this one, okay? We'll explain you. CMM, call money market. Think that there is a Punjab Bank, okay, and there is SBI Bank. If the Punjab Bank want a loan for overnight purpose, the Punjab Bank will call for SBI manager, okay, chief manager, and tell that I need 20 crores as a loans for one day, overnight, and SBI will give that money for one day. That is called as call money market. It's like a friends, okay? The friend will call and he will tell, I'm having emergency, I want a loan for one day. Okay, that's the same thing, the same process here. It is uncollateralized overnight funds among banks. Bank to bank will give the loans here, not RBI. RBI don't come into the picture in CMM, call money market. Who will be there? It is among the banks, they will just give the loans. Okay. Bank to bank, the loans will be given. But to uncollateralized, there will be no collateral. Why? Because why there is no collateral? It is just overnight. It means that only for one day it needs a loan. The next day, Punjab Bank will give a money for this SBI. Think that if there is any short deposits, okay, if there is short deposits of 20 crore for Punjab Bank, it will call for SBI and it will tell that I need 20 crore, I will pay you tomorrow, okay, and SBI will offer the 20 crores mutually. This is like helping each other, that to between banks itself. There is no SBI, there is no RBI comes into the picture. Bank to bank loans will be provided. Is there any doubt here? Okay. Just write down like this, bank to bank loan. Okay, write in the keywords. Bank to bank will be provided as a loan for overnight or for one day. Based on a trust, they will provide the loans. Okay. Next comes liquidity adjustment facility. It is a mechanism that enables to manage short-term liquidity mismatches interacting with the RBI on the daily basis. What is liquidity? Liquidity money means more money. If there is high liquidity, high money is there. If there is less liquidity, less money. Okay. See, if there is any mismatch in a liquidity, that is called as liquidity adjustment facility. Okay. It is a mechanism that enables bank, if the bank is having short-term liquidity mismatches. For short-term, if the bank is not having much money, it will take the help from RBI. Understood? If the bank is having less money and it wants some money for short-term, then it will ask for the RBI to give as a loan. Okay. Same like a repo rate and reverse repo rate. There they have given here. See, for repo rate and reverse repo rate transaction के लिए. Okay. And this is introduced in 2000. Okay. Currently, the repo rate is 5.5 percentage. Currently currently LAF is 5.50 percentage. How does LAF work? Okay, RBI is the one, it will inject the money in a market. RBI is the one, it will absorb the money in a market with the help of LAF. Understood? Liquidity adjustment facility. See, repo operation. How does LAF work? Based on repo and reverse repo operation. Okay. Repo operation, under the repo transaction, bank borrows funds from the RBI. What is repo? Bank will just take the loans from the RBI. Howda? When the bank borrows funds from the RBI by selling what? Government security. As a collateral, it should keep under RBI. Okay. And with an agreement to repurchase them at the future date. Just let me give one example for you. See here. There is RBI. There is bank. Who wants a loan? Bank want a loan. Okay, bank want a loan here. Bank should keep what? Collateral in the form of government securities, government bond. RBI will provide the loan for whom? Bank. Concentrate here. RBI will give a loan for bank. Now the bank is having huge money. What does this bank will do? It will give our money for whom? Customers. Now customers will be having more money. Okay. When the customers having more money, it is called as liquidity injection. Injection means injecting the money in the market, providing more money in the market. Understood? This is called as repo operation. This is called as liquidity adjustment facility. If the customers, think that RBI thinks that if the customers wants more money in the market, it will tell that RBI will provide loans for the banks at lesser interest rate. Lesser interest rate for the banks. Okay. And when the banks get the loans at lesser interest rate, think that it is for 3.5 percentage. Okay. And this bank will provide a loans for customers at 6 or 7 percentage. This is not much a huge interest rate for the customers now. Understood? Okay. This is called as liquidity injection, making more money in a market. RBI will not directly give or provide the money for the customers here. It will control, or it will just totally this inflation deflation is under the hands of RBI itself. You see, if the RBI provides a loan at lesser interest rate for the banks, obviously the bank will also charge the interest rate at lesser price for customers. If it not provides at 3.5, if it provides at 5 percentage, then here how much? 9 to 10 percentage. This is a huge interest rate for the customers now. The customers will not take the loans at this much of interest rate. If the people want more money, the RBI thinks that we should inject the money in a market, it will make the repo rate at lesser price. Lesser interest rate. Are you understanding? Okay. Think that Rohan want a loan. If loan is provided at the rate of 5 percentage, will he takes a loan, or if he takes it at a 9%, he will just take the loan at 9%. Which one you will choose? 5%. See, these kinds of customers, okay, like a Rohan, they want the loans, okay, that interest rate should be lesser itself. When it's lesser, then you will be taking the loan. When you are taking the loan, it is called as injecting the money in a market. Understood? If it charges 3.5% here and the bank sell it at 5%, then you will take a loan. If RBI only selling at 5% here for the banks, then bank will charge at 9 or 10%. Now, are you able to take the loan at 9%? No, you will not like to take this loan at 9%. If you want at lesser interest rate only, then you will take the loan. If not, you will not get any kinds of loans. Understood? If people wants more money, if the RBI thinks that now it's the time to inject the money in a market, it will decrease the repo rate. When it decreases the repo rate, obviously banks will also charge lesser interest rate for the customers. Next is reverse repo rate, means liquidity absorption. This is vice versa. If the people are having more money, okay, think that. The customers are having more money. If the customers are having more money, it will lead to what? Inflation. In order to control the inflation, RBI will tell the bank that, okay, sorry, if the customer is having more money, it will lead to inflation. Why? Because you will be having a lot of money, you will go for the market and you will purchase a lot of goods. Then it will lead to inflation. When the demand increases, it will lead to inflation. The RBI will instruct for the banks that now it's your time to provide high interest rate for their deposits. Okay. If there is high interest rate for the deposits, obviously customers, what they will do? Instead of purchasing goods in a market, they will shift and they will deposit the money in a banks. Now, banks, what it will be doing? It will be having surplus of money now. When all these kind of people, when they get attracted for higher interest rate and the deposit amount in a bank, it will lead to lump sum of amount. No, nobody is taking a loan now. What it will do? It will keep under RBI. That is called as absorbing the money from the customers. How it has absorbed the money? Increasing the higher rate for its deposit. Understood? That is what they have given here. In the reverse repo rate transaction, banks lends surplus funds to the RBI. As I told you, when there is a surplus of money, RBI will take that money. This is how liquidity can be absorbed and can be injected. Very important. LAF is very important for your exam. Just write it in your own words. Did you got my point? How the RBI will inject and absorb the money from the market? Okay. So in order to control the inflation, it does these kind of tactics. As I told you, SDF, regarding SDF, RBI to absorb RBI to absorb excess liquidity without collateral. Okay. Already you know what is SDF. Okay. Next is MSF. Already I have taught you. Next, very important. Okay, let me teach open market operation in next slides. Firstly, you should know what is bonds and treasury bills. Okay. What is bond? Bond is a long-term government debt with coupon payment. If it is more than 1 year, it is called as bond. If it is less than 1 year, it is called as treasury bills. That is for 91 days. Just write down 14 days also. 14, 90, 91, 182, 364 days. That is called as treasury bills. If the security, just concentrate here. If the government security is for short term, like 14 days, 91 days, 182 and 364 days, it is called as T-bills, treasury bills. If it is more than 1 year, it is called as government bond. Okay. If it is 1 day also, it is called as T-bill. Yeah. But in call money market, there is no collateral itself. Call money market will not come under T-bill at all. Okay. Since it is a non-collateral. These are the collateral. Collateral in the form of government bond or T-bills. GSEC, wherever have written GSEC, government security. GSEC means government securities. Government securities will in the form of government bond or T-bills. Government bond means for more than 1 year. T-bill means it is less than 1 year. Just take a break. We'll continue after 15 minutes. Next is scheduled banks. These are the banks that is listed in the second schedule of the RBI Act 1934. Which are the scheduled banks in India? The same SBI Bank. Okay. Just check which are the scheduled banks in India. It might be scheduled commercial banks also. These are called as scheduled commercial banks also. Scheduled commercial banks in India. Axis Bank, ICICI Bank, SBI Bank, Canara Bank, Federal Bank. All these are called as scheduled commercial banks. Why? Because they have listed in the RBI Act. These all the banks have been listed in the RBI Act 1934 in the second schedule. That is why these are called as scheduled commercial banks. And those banks which are listed in scheduled commercial banks, they will also get certain facilities from the RBI. Like their loans will be provided as early as possible under repo rate, under SL, under also SDF. Okay. NBFC banks don't get any kinds of loans from the RBI. Understood? The banks can take the loan from the RBI by at least providing the collateral. But whatever this non-banking financial corporation, NBFC banks, those banks can't get, those companies can't get the loans from the RBI. Next is regional rural banks, that is RRBs. Ownership, 50% of the ownership will be under the hands of Government of India. 35% is the sponsors bank. Rest state government will having the ownership of 15%. Okay. And this is regulated by whom? RBI. The RRB banks will be regulated by the RBI itself, and it is supervised by the NABARD. What is full form of NABARD? National Agriculture Bank for Agriculture Development. National Bank for Agriculture Rural Development. Okay. NABARD. Oversighted by RBI, NABARD, and also state registrators. In rural areas, there will be RRBs. Okay, they will provide the loan for the farmers and for the loan takers in a rural level. Do you know society banks? Just give me a minute.
They're not using all images now. Could use what? It was part of it.
Is there any doubt in this? Okay. At rural level, they will provide the loans for the customers. In order to establish regional rural banks, who are the owners? Who are the owners? Government of India is having the share round about 50%. Sponsors bank, it is round about 35%. Sponsor bank means NABARD. State government. Central government, state government. It has ownership of 15%. Is there any doubt in this? No doubt. What you have studied? Okay, let us revise quickly. First, what is bank? And also which are the different types of banks, the names of the banks. What is NBFC? Okay, and different types of NBFC under different acts also. Next is RBI role, RBI function. Next is NDTL definition. And next is different types of rates, repo rate, reverse repo rate, SDF, MSF, and their interest rate, current interest rate. Okay, it is of quarterly basis. For every quarters, the RBI will revise that. It might decrease or it might increase these rates based on inflation also. Next, bank rate. Next, we are having reserve ratio. Reserve ratio will be in the form of two types, CRR and SLR. CRR will be 4%. It is totally 4% of the cash should be reserved. SLR means statutory liquidity ratio will be in the form of cash, gold, government security. How much percentage? 18%. 18 plus 4, 22% should be under the hands of RBI itself. Okay. For CRR deposits, it will not get any interest rate. For this one, RBI will give the interest rate. Then call money market means one bank will call for another bank for loan purpose, for overnight purpose. That too uncollateral. What is LAF? Liquidity adjustment facility. If there is any mismatch in liquidity, okay, that is happens with the help of repo rate and reverse repo rate. One is how to inject a liquid in a market. How to inject a money in a market. One is how to absorb a money in a market. That is what they have given now. Next, SDF and also MSF already we have seen in the table itself. And just go through that. Next, bonds and treasury bill. G securities. These are the G securities. G securities in the form of government bond and T-bills. G security means government bond. If it is more than 1 year, it is government bond. If it is short term, it is T-bill. Let me explain here. T-bill means for short term loan they will be using. Where you will be using T-bill? Just tell me in the table. Just see this table and let me know. Wherever there is a short-term loan, the collateral will be in the form of what? T-bills. Okay. Here also T-bill. Reverse repo rate also T-bill. Yes, wherever there is short-term loan means T-bill. In T-bill, they are doing the collateral. They are just having the collateral. Long-term loan. Where is the long-term? Okay, here also short-term. Here short-term loan. Okay. Here there is a long-term loan. Long-term loan means what is the collateral here they are using? Government bond. Here they are using government bond. Long-term means more than 1 year. Means it will be in the form of G bonds, government bonds. Next, scheduled banks and RRBs. Let us study regarding the open market operation also. Is there any doubt till now? Very important. Frequently asked questions for your IB and also for your UPSC. You should know. One is open market operation, another one is operation twist. Asha, do you know regarding this? Have you heard? Okay. Okay. See. In order to control, just concentrate here, don't write. In order to control a money supply in a market, RBI will use two types. One is open market operation and another one is operation twist. Okay. What is open market operation? Okay. Here in open market operation, in order to inject the money in a market, in order to absorb the money in the market, it will do open market operation. Liquidity adjustment facility, LAF, whatever you have learned, that is also a correct one to absorb and to inject the money in the market. This is also one of the technique it will use. LAF is there to control the inflation. Open market operation, operation twist is there to control the operation, control the inflation. Okay, here. Open market operation. Open market operation means buying and selling of government securities to control open market by the RBI to control supply of money in the market. Buying and selling of government securities like bonds. Concentrate here, don't write. Concentrate. Think there is an inflation. Think there is an inflation. When there is an inflation, how does this inflation will occur? If the money is more in the hands of people or if the money is less in the hands of people? If the money is more, okay, means the money supply is more. If the money supply is more, what the people will do? They will go for the market and they will start to purchase more number of goods. That will lead to what? Increase in demand. Okay. If the demand increases, price will increase. Supply will be what? Less. Then it will lead to what? Price. If the price is increased, it is called as inflation. In order to control the inflation, okay, what the RBI will do is, here, see, RBI, there is a bank, there is a customers. There are customers. Okay. Now, in order to control the inflation, controlling inflation means people are having more money. Because of that only it is leading to inflation. Have to absorb the money. Now, in order to absorb the money, here, what it will do? Will it buy the government security or will it sell the government security? That is the question. Now, the RBI will buy the security or it will it will sell the security. It will buy or sell. See, customers is having more money now because of inflation. During inflation, customer will be having more inflation. In order to absorb the money from the customers, in order to absorb the money from the market, that is from the customers, what they will do? They will increase the interest rate. This bank will attract the people and it will tell that we will provide higher interest rate for your deposits. You're correct. Now, what they will do is when they are having huge money, now RBI, what it will do? In order to absorb this money what the RBI will do? It will sell the government security. Now what it will give?
Money.
Bank will give money. Customers will have given money for the banks deposit. Now bank is having more money. What it will do? It will be given for RBI. RBI, what it will give? Government securities. That's it. If you provide me government security, then only I will give the money for you. Government security is asset. It is not liability. Why? Because it is not risky. That instrument, the so-called the government security instrument, is asset actually. Okay. Whenever you sell, it is having the value. You will get your money back. It is 100% assurance. Understood? See, that is what they have given. This is the answer. Concentrate here. When there is an inflation, RBI will sell government security in order to reduce the liquidity. Means in order to decrease the money in a market. That's why what it will do? It will sell the government security. RBI will sell government security to the banks. Banks, what it will give? Money. When there is no money, people will also not get much money now. Then if there is not much money, it will not lead to inflation. When there is no money in the hands of people, what it will make? If the supply is less, demand will be less. Why? People, if the money is not if the money is not in the hands of people, they will not go for the market and they will not purchase the goods. If they don't purchase the goods, demand will be less. If the demand is less, price will be less. Inflation is got controlled. It is vice versa now. Opposite of inflation, deflation. Okay. Just write down this one for this point in your own words. See, after a few days, you will not understand this concept. Okay, based on this only, you will get to understand at least what is that. Let me explain that first one also. Firstly, write down this one. RBI sells government security in order to reduce liquidity. Banks will be keeping the treasure or asset gold and government securities only. See, you need high imagination, power and practicality to think in a better way. You can't by heart this economy. You should understand the economy. Are you understanding the economy or not? Okay. Let us go for deflation now. You should only tell me. Okay. When there is a deflation, okay, when there is a deflation, is money supply less or more in a market? Money supply will be less. Okay. If there is deflation, demand will get decrease. Okay. Why? Because when there is a huge supply of goods, when there is a huge supply of goods, what it will lead to? Demand will be less. If demand is less, price will be less. What is the definition of deflation? less in price, decrease in price is called as deflation. Understood? And this deflation means there is lesser money in market. Okay, the lesser money in a market. And if there is lesser money in the market, what the RBI will do? RBI will inject the money in the market. Okay. What is deflation? Less price of goods. If there is less price of goods, will the government get more taxes? Will the less price of goods, will the government get more taxes? No. Let me give an example. Think that petrol is 101 rupee now. It is inflation. If it comes to the 80 rupees, it is disinflation. If it comes to the 20 rupees per liter, deflation. In this money, at least it will get 10 rupees as a tax. 10 rupees. Here, in 101 rupees, it is getting 70 rupees as a tax. In 80 rupees, it is getting 50 rupees as a tax. Which is good for economy? 70 rupees. Inflation or else disinflation also. If the price of goods is less, the lesser will be the tax. With that lesser tax, can India be developed? With the less tax, can India be developed? No, it is not. That is why what it will do? RBI will inject the money in the market now. When there is a cheap goods, very cheap goods, the government will not get much taxes. In order to increase the tax, again it will inject the money in the market. How it will inject the money? Now, how it will inject the money? It will, whatever the banks is having the, in order to inject the money, what it will do? Bank will buy the government security from the banks and it will give the money for the bank now. If the bank is having more money, what it will give? What it will do? It will lend a loan for the customers now. Now the customers will be having more money. If they are again having more money, it will lead to the inflation. Again inflation, deflation, deflation, inflation. This is a cycle. If there is an inflation, it will be controlled. If there is a deflation, again the money supplies will be increased. It is a cycle. Okay. Moderate inflation is good for economy, but high inflation is bad for economy. Okay. Inflation should be there, but it should be in moderate term. That is inflation targeting. What is the inflation targeting? What is the range? 2 to 6%. 4% is there, plus or minus 2%. That is a healthy inflation. If it is more inflation means it is burden for customers, people. Understood? This is how it works regarding open market operation. Now, did you got my point? Open market operation will help to control inflation and deflation. That's it. Now you can write down. If the, see here, just concentrate. RBI will buy the government security from the bank. Now, what is the role of RBI? It will give a money for the bank. When there is a huge money in a bank, what it will do? It will provide a loans for the customers at lesser rate of interest or higher rate of interest. When it is having huge money, will it charge higher rate of interest rate for customers or it will decrease the interest rate? It should decrease. When it is having huge money, no one is taking the loan. What it will do? It should decrease the interest rate. Okay. Here, decrease of interest rate for loans. Loans will be provided lesser interest rate. Then the people will get attracted and they will take the loans. And again, the people will be having more money in their hands. When there is a more money in the hands, people go for the market. They will start to purchase the goods. Again, whatever the price that was been fallen, again it will start to increase. Understood? The price is increase, it will be decreasing, and if the price decrease, it will be getting increased. That is totally under the hands of RBI. Understood? Example, that is what given here. RBI sold 10,000 crore rupees of securities during 2022 in order to reduce the inflation. Okay, and in order to, okay, this is RBI bought 10,000 crore worth of securities, infusing money into the banks. Okay, one for inflation, one for deflation. It has been done. During COVID, do people had money in their hands? They didn't have lot of money. What it had done? It has infused the money. Now just give me the answer properly. Okay. During COVID, customers or the market customers didn't had much money. In order to infuse the money, what the RBI done? In order to infuse a money in a market, what the RBI done? RBI purchased government securities from what? Banks. The RBI, when there is no money for the customers, it is the duty of the RBI to give money for the banks, and money which bank should give the money for the customers. Money here, money there. Okay. If there is no money during COVID, see how RBI has given money for the banks, bank has given money for the customers. Instead, what is the collateral they should keep? Government securities. Okay. Here also, interest rate is lesser for loans. People will take the loan. That is what they have done here in COVID time. Understood? Next comes the Operation Twist. It is also launched in India in 2019. Operation Twist. Open market operation twist will be made by the RBI itself. Okay, just concentrate here. Government will instruct the RBI to control inflation and deflation. Directly, the government can't control the inflation or deflation. It will instruct whom? RBI. Now RBI comes into picture and it will control inflation and deflation by doing open market operation. Okay. Then next comes the Operation Twist. Operation Twist means simultaneously buying long-term bonds and selling short-term bonds. See, it is very difficult to understand. Concentrate here. Don't write. Okay. See. Concentrate. Don't write. Keep the pens down. Government wants a loan of 50,000 crore. Think, if the government wants 50,000 crore rupees, okay, this government will give the instruction for the RBI that you sell my government securities, but I want 50,000 crore rupees for investment purpose in different sectors. Road and transportation, for women empowerment, in other sectors, it wanted to invest the money. Now, what the RBI will do is, it will simultaneously sell and buy the government securities. Simultaneously it will do. Okay. What it is selling? short-term bonds. And what it is buying? Long-term bonds. Let me tell you why it is buying long-term bond and why it is selling short-term bond. Okay. See here. Now, let me give one example for you. Just put one example. Operation twist. Just write down operation twist. Next is please do this. Okay, operation twist. Okay. See you. This is one of the bond. Concentrate here, don't write. This is a bond. This is called as bond price. Bond price, that is face value. Okay. Face value. Coupon and yield rate. Think that this bond price is of 1,000 rupees. If this government bond is of 1,000 rupees, okay, after long term, here the long term bond means more than 5 years or 10 years or 15 years, 20 years. Long term bond means more than 10 years. Okay. Think that if the long term bond, this long term bond is of more than 10 years, okay, annual coupon, the annual coupon is of 60 rupees for 1,000 rupees. Annually you will be getting how much rupee? 60 rupees for your 1,000 rupees coupon, sorry, 1,000 rupees long term bond. This bond worth 1,000 rupees only. Okay, but they will pay how much? 60 rupees annually. Now what is the interest rate? Yield rate means profit. At what price? Now what is this? 60 divided by 1,000 into 100. What is the answer? It is 6%. Concentrate here. If the bond price or a face value is 1,000 rupees and annual coupon is 60 rupees, every year you will be getting 60 rupees for 10 years. For 1,000 rupees. For 1,000 rupees every year you will be getting 60 rupees. Means in percentage how much it will be? 6%. Means 60 divided by 1,000 into 100. If you want in a percentage you should go 100 into 100. Understood? This is maths. It is 6% now. Okay. Now, what they have given? They started to buy what? As in the definition, it is buying long-term loan. If they are buying long-term loans, sorry, long-term bonds from the people, okay, what will be the supply now? If the government started to buy these kinds of bonds from the people, then what it will lead to? Will the supply will be? If these kinds of bonds are more in number in the market, Okay, it is in the hands of people or else any banks. Now, according to the definition, they have told that they are buying the long-term bond. If they buy long-term bond, what is the supply and what is the effect on demand now? If they buy more, what it will happen? Demand will be high for that bond. Okay, if the government purchases this long-term bond, it will happen to? If it will be more in number. This price will be more. Why? Because people start to what? Selling this long-term bonds for the government now. And obviously, when there is more number of people selling this 1,000 rupee bond, this price face value get increased to 1,050 rupee. Sorry, 1,050 rupees. Understood? If the people are selling for government, if the government purchases this long-term bond, what it will happen? This 1,000 rupees will become 1,050. Means it will lose its demand because more number of people are selling. Sorry, more number of people are selling for the government. Government is buying that. Understood? If the demand is, sorry, if this value is more, okay, now you calculate. If it is 60, it is same. Annual coupon is 60. Okay. Now 60 divided by 1050 into 100. What is the percentage? 1050 divided by 60. 5.71 percentage. Okay. 5.71 percentage. Is this good or this one is good for the customers? 6 percentage good for you people, but this one is lesser. Since the yield rate is less, now it is a time for getting the long-term loan at lesser price now. Why? Because it is not having much demand now. When you are getting only 5.71 percentage, okay, then it is not having much demand now. Okay. Now what it will lead to? If the people are not taking these kinds of bond, if the people are selling these kinds of bonds, obviously you will get long-term loan at lesser price. If the people get long-term loan at interest rate at lesser price, then this is the time they will take the loans for house loans and for vehicle loans. If the long-term loan is lesser at interest rate, will you take a long-term loan or not? Okay, in order to induce the money in a market for a long-term loan buyers, that is why they are doing Operation Twist. Think that you want a house loan, you want a car loan, you want a property loan for more than 10 years. If it costs more, will you take a loan? No. If it costs lesser interest rate only, you will go for the bank and you will take the loan. In order to reduce the interest rate for a long-term loan people, is why they will buy a long-term bonds. That buying the long-term bond will lead to decrease in long-term loans also. Understood? It is based on this only, as I told you. Okay. When government starts buying lot of long-term bond, it loses its value. You should pay this much now. Whoever have paid this much, they have got 6% of a yield rate. That is good rate. In order to purchase a face value of 1,000 rupees, that old government bond, now you should pay how much? 1,050. Now what is the profit for you? 5.71. You are losing how much? 0.29% you are losing. Understood? When you are losing that much, when it is not having demand, then what it will lead to? Long-term loans will also make into a cheaper price. Understood? Is there any doubt? Just write down this example, both of them. See, I know it is quite difficult to understand this, but this is important for your exam. Just write down both this one and also this one, 5.71% also. See, why the operation twist is happening is that, okay, just let me answer you, just concentrate here. Here, there are customers. There is a bank and there is a RBI also. Under repo rate, okay, what is repo rate? RBI will provide loans to the banks. RBI will provide loans to the bank at, think that if it is at lower interest rate, if it is RBI is charging at interest rate for repo rate of 4%, then for customers how much they will charge? Think it is +5, it is 9%. The bank loan, the customers will be getting at 9%. If it is 2%, lesser repo rate means they will charge 5%. Instead of charging only 5, bank will not reduce this one. Bank is just selling it at 9% only. In order to control the banks, that is why operation twist is happening. Some of the banks, even though the repo rate is given at lesser interest rate also, 3%, 3.5 also, these banks will not listen for the RBI. What it will do? It will create a huge burden. It will charge more interest rate for the customers. In order to control these people, that is why operation twist happens. Understood? Now, what it will happen here? Now, at operation twist, what will happen? What will happen? Long-term bond will be purchased or buyed from whom? RBI. When the long-term bond is bought or purchased, what it will lead to? It will increase its bond rate. If the price is increased, yield rate will be decreased. See, inversely proportional. Inversely proportional. Just write it in a note. Bond price is more, yield rate will be less. Inversely proportional. Write it in note. If the bond price is high, yield rate will be less. Example I have given. For 1000, if it is annually 60 rupees, 6%. If it is 1050, for 60, it is 5.71. Just write down that. Yield rate means whatever the rate I have written here. This is what? Yield rate. Interest rate only. Yield rate means interest rate or profit. Yield rate means profit. Just write out in the bracket. Yield rate means profit. Next slide, okay. Just write down. Write down the example also for this. Okay. 1000 rupees. 60 by 1000 rupees. You will be getting 6%. Okay. And 60 by 1050 equal to 5.71%. Lesser the bond rate, higher will be yield rate. Here the bond rate is high and less yield rate. Bond price should not go up. Otherwise, you will be losing the money. You will be losing your profit. Is there any confusion? Rohan, Harsha, have you understanding? Both are inversely proportional. Bond prices should not go up. Otherwise, instead of paying 1000 rupees, you will be paying 1050. If you pay 1050, your profit will be less. Understood? Now, let's concentrate here. Okay. Exit. Now, in operation twist, what will happen? What they will purchase? What the RBI will purchase? RBI will purchase what? RBI will buy what? Long-term loans. If it buys long-term loans, if it buys long-term bonds more in number, what it will lead to? Price will increase 1000 rupees to 1050. Okay, yield will be falling, and that will lead to long-term loans rates reduces. Whatever the interest rate the customers needs, that will be in lesser in interest rate. And see here, RBI sells short-term bonds. Okay, just write down example. RBI sells short-term bonds. RBI sells short-term bonds. Okay, RBI sells short-term bonds. Concentrate here. RBI, firstly, what it will do is, Harsha, concentrate here. Firstly, RBI will sell the short-term bond. By getting the money, if it sells the short-term bond, what it will get? It will get the money. Once it gets the money, then it will buy the long-term bond. Understood? Firstly, RBI will not think that RBI will not invest in anything. RBI, with the help of intelligence, what it will do is, firstly, the first process, what it will do? It will sell the short-term bond. Once it sells the short-term bond, it will get a money. In that money only, it will buy long-term bond and it will give money for the customers. Okay. See here, when RBI sells short-term bonds, okay, short-term bonds means less than 1 year. Okay, think that 1000 rupee bond is given at 980 rupees. See, in the market, if any of the person is selling the vegetable at 20 rupees and other one person is selling it at 15 rupees, where you will go and you will buy? 15 rupees in, okay, the same way here. If that it is 1000 rupees, obviously you will save how much money? 20 rupees. Here, see, 980 rupees divided by 60, whatever the coupon bond. Okay, write down. This is the face value. 16. Now, do it in a percentage. Just write down annual coupon. Annual coupon is 60 rupees. 6.3, 6.12, 6.12 percentage. Now have you got my point? If the bond rate is 1000 rupee and if it is selling at 980 rupees, people will buy that. When people buy, What they will give? Money for the RBI. Understood? Now with that money, RBI what it will do? It will buy long-term bonds. Understood? Think that if the RBI sold 50,000 crore rupees worth, 50,000 crore rupees worth short-term bonds, okay, 50,000 crore rupees short-term bonds, that will be in the form of bonds, and once it sells, it will get 50,000 crore rupees. It will just buy all the long-term bonds that is there in a market. Who is the market here? Customers or the bank. Understood? Is there any doubt? In order to decrease the long-term rates, that is why it will do open market operation. Okay. Is there any doubt? What is difference between OMO and OT? Open market operation is either buying or selling government security here. But in operation twist, it is simultaneously buying and selling government security. Okay. Here, open market operation is aimed to control liquidity and inflation. Here, what it will do? It will adjust long-term interest rate. It will decrease or it can increase also. Example they have given here. Is there any doubt? What? Both. Okay, RBI buys securities in slowdown, that is deflation. Sells in inflation. Okay. There were 2 points. Just let me show you. This one. Sorry. This is operation twist. Yeah, this one. This is what they have given as an example. Okay. Yeah. Okay. RBI buys long term and sells short term bonds. This kind of news will be in the headlines once in a year.
Are there like the securities slowdown? Then that there was a stock and bear something.
Bear bull in regarding the stock you are telling. Okay. See, what is bear and what is bull? When the stock prices rise, it is called as bear. Sorry, bull. When the stock price is less, it is called as bear. In order to make it vice versa, what the RBI will do? Again, if the people have lot of money, they will purchase stocks. If they purchase stocks, the price will shoot up. Okay, if think that. See, this is also related to the stock market only. Okay, banking. See, there is one company. It is selling the stock at 10 rupees per stock. Okay, and there is another company that is selling the stock. Okay, per stock maybe 100 rupees. Think this is X company, this is Y company. Which is bearish and which is bull? Bull means higher price. Bear means lesser price. Bull will run faster than bear. Do bull will run faster than bear or not? There is a bull, there is bear. Okay. Bull will run faster. That is why they have kept a name bull. Bear will run slower than bull. That is why they have kept name bear. Understood? Think that this 10 rupee per stock, if it becomes 8 rupees per stock, And if it becomes 120 rupees per stock, which is bear and which is bull? This is bull. Price have been shoot up. Your price have been decreased. This is bear. Now, what it will do? RBI will inject the money in the market. Once it injects some money in the market, people will be having more money. What the people will do? When the people will be having more money, at lower price, will they buy or not? What is the stock market? How the stock market works? When it is at lesser price, people will buy more. When the price shoot up, people will sell that stock. Yes. See, in order to control the SEBI, this is what? Okay, in order to control the money in the market, when the stock market has fallen, when the overall stock market is fallen, what the people will do? See, when the stock market has fallen, okay, now RBI will inject the money into the market. RBI will inject the money into the market. Market means you people. When you will be having lot of money, what you people will do? You will purchase the stocks. Why? Because you will be getting at lesser price. When you should buy a stock is when it is at lesser price, you should buy that stock. When it increases the price, you should sell during that time. Understood? This is a common sense question. Okay. And when the market is having more money, what it will do? People will start to buy. And when the people starts to buy, what the price will become? Price will increase. Why? Demand has increased. When more number of people are buying that, demand will get increased. Price will become increased to 12 or 15 rupees. Understood? That is how it works. Okay, is there any doubt? Okay. See, ultimately, if the people have money, they will purchase the goods, stocks, cryptocurrency, or they will invest in a bank. It is totally under the hands of banks. It is totally under the hands of RBI itself. It can inject the money, it can absorb the money. Understood? Is there any doubt? No doubts. Government will give instruction for the RBI. When people will scold badly, when the people will condemn the government that you have done lot of inflation, electricity bill is too much high, milk price is too much high, groceries price is too much high. When you condemn the government, the ruling party will instruct the RBI. The people are against us now. I don't want people to be against us. Kindly control them. What they will do? They will inject the money in the market. Understood? This is how it turns. Government will give instruction. Government will give recommendation for the RBI to control the inflation. Understood? This is regarding open market operation and operation twist. Yeah. Okay. Okay. Within 5 minutes, we will wind up the class. Okay. Lastly, cooperative banks. Cooperative bank. These are the entities that is owned and operated by the members or the customers. That is called as cooperative bank. Cooperative bank will be of 3 types. One is primary agriculture credit societies. Okay, at village level, there will be cooperative societies. At district level, they will be having DCC bank. Have you heard name DCC bank? Okay. And at state level, there will be one state cooperative bank. In urban level, they will be having urban cooperative bank. That's it. Next, stocks of money. Okay. There is M1, M2, M3, M4. Okay, that is called as money supply measures taken by the RBI. This formula is important for your exams. Okay, what is MO? Sorry, M0. M0 means reserve money, means high powered money. This high powered money means currency in circulation. Whatever in a market the currency is there, that one plus bankers deposit with RBI. Whatever the customers are having the money, that will be under banks. Banks will be under RBI. The same, that one, and other deposits with RBI. This is called high powered money. Next comes the narrow money. Here, currency with public plus demand deposits with banks. Demand deposits will be in the form of saving and current account. That one plus other deposits with bank. That is the formula. Next, M2 means M1 plus whatever the post office saving is there. That is called as M2. M3, it is a broad money. M2 is narrow money. This is broad money. Broad money means M1 plus time deposit with bank. Now comes the fixed deposit here. Most commonly used. Here comes what? Sorry. Here comes demand deposit. Okay. Means here this all plus time deposit. Saving money, sorry, saving account, current account, time deposit, fixed account. That all is included. It's called as broad money. That's why it is called as broad money. Lastly, M4 means M3 plus total deposit with postal office saving blank, excluding what? NSC. Okay. Just search what is NSC. National Saving Certificate. Okay. See, this National Saving Certificate is a fixed income certificate, fixed income investment scheme offered by the Indian government through post office. Okay. That is excluded. Next one we will just teach you tomorrow. Okay. CRR, sovereign gold bond. I will just send you the PDF. You can just study that. Have you understood?